Well, good afternoon and welcome to the December Crop and Livestock Outlook brought to you by the Ag Business and Policy Division of MU Extension. Today, myself, John Cruz, and Marty Foreman will be delivering the talk. Scott Brown and Wesley Tucker, who normally do livestock, are going to be out, but all pinch hit for them this month. Um, so I want to get started. Just a quick layout of what we're planning to do. We're going to go through some special topics, talk about a few developments in the market. Marty's going to cover the corn and wheat outlook. I'm going to cover the soybean outlook and the livestock outlook. So, with that, I'm going to jump right into special topics. And I wanted to make you aware of the farm program decision support meetings that we have now started. And you can see on there a list of the different locations. And we hope that you're able to return to attend one of those. It'll give you some good background information on uh, uh, what you need to know to make decisions about which program you want to participate in the coming year and what programs are available. So we're teamed up with FSA and MU Extension, and we're holding these meetings around the state and hoping that you're able to attend. And you'll notice that we also have some pending locations there at the bottom of the screen. So if you aren't able to catch one of the meetings or don't see one in your area, let us know, and we'll see if we can what we can do about that. So just a couple of things, incidentally, about Farm Bill or Farm Program sign up. One of the things to watch out for is March 15th of uh, of 2020 on this slide. It says 2019, but it should be March uh, 15th of 2020 is the last day you can get signed up for the 2019 program. And one of the things that you want to be careful about is you can also sign up at the same time for the 2020 program, but you don't have to do it in March. You can wait till as late as June. So keep that in mind. Also, notice that then every year after 2020, you will have an opportunity or you need to be signed up by the 15th of March. So, a couple of deadlines coming up to kind of keep track of. The other thing that we're also going to be starting in late January, early February are a series of grain marketing workshops and meetings. This is a three-stage process where we're really trying to get at helping producers set up a marketing plan and sticking to it. As we've looked at the data and we look at the number of producers marketing in the lowest uh, uh, third of the price distribution in a given year, we're finding that on average, about 40% of our producers of soybeans are down in that are marketing their soybeans in the bottom third of prices. And so and a similar story for corn. And so one of the reasons that's what's the driving force behind getting these workshops out there. We'd like to get you guys another 25 cents on corn price and another 40 cents on soybean price. And so that's what we're looking at. That's what we're after. And so we're setting up these meetings. We want to first of all kind of get you familiar with cost of production around the state, what other data is out there, and what that means in terms of dollars per bushel. Help you understand what your local basis is in your area and why that matters. Some of the basics of the futures market. Developing a marketing plan. That's our real goal out of this, so that you can hit those higher price targets and not the top price, but higher prices in general. And then past performance. We want to give you some perception of how some of these strategies have worked in the past. And then finally, we'd like for you to leave with a really good idea of how to develop your own marketing plan and the ability to monitor the performance of your whatever marketing plan or strategy that you come up with. So that's the first tier of meetings. There is a second and third tier that follow up with you and see how you're doing on those things. And so that's our goal for the marketing workshops. As we look at each month, I've been trying to give everyone an update on the U.S.-China trade war, and one of the ways we monitor that is to look at the Brazilian port price for soybeans versus the U.S. port price. On this graph, you can see the red line here is the Brazilian port price, and the blue line is the U.S. port price. And when those lines are relatively close together, that usually means that there isn't a distortion out there in the marketplace caused by some sort of tariff or trade barrier. And what you can see here recently is there's a little bit of a gap here in prices right at the moment. That's probably not any different than normal, but it is. So we're probably looking at not much distortion from the trade war at this particular point in time. However, we keep an eye on it, and you can see last year at this time, there was a pretty big distortion, and Brazil was essentially able to get some very high prices from China because China had essentially stopped all imports from the U.S. So that's a current status. One of the other things I was going to comment on, we've noticed here in the last day or so that there has been a lot of discussion about a possible trade resolution. It's actually started to perk up some of the markets and pull up prices a bit. So we'll see where that goes. Keep an eye on that, and it may give you a pricing opportunity either for 2019 or 2020's crop. So with that, I'm going to turn it over to Marty for the corn outlook.
Thanks, John. So first of all, just comment that the WASDE this month didn't change. USDA made no revisions to the supply-demand forecast this month. So pretty static set of numbers there this month, though plenty of other things to talk about. One thing to keep in mind is this January 10th date next month. That's when USDA will issue several key reports. So they'll finalize the crop production numbers then. Also, clearly revise anything on the supply-demand based on the production and make any changes they need to for supply and demand. Also, at that time, they'll issue the December 1 grain stocks. So the quarterly grain stocks numbers will be out. So that's particularly important for corn because that gives us an idea of how feed demand is running for corn for that first fall quarter of the marketing year. So that'll also be key. Demand on corn has been sluggish thus far. We've seen downward revisions in a lot of the demand numbers up to this month, and exports have been particularly soft. Now, one of the things, in addition to the ideas about some possible trade resolution, kind of buoyed the markets a bit today, was news that we did see a big sale export corn to Mexico. So sales to Mexico have been lagging pretty dramatically. We'll take a look at that in a minute. But that sale was one of the largest we've seen in a long time. In fact, it was, I think, 1.6 million tons. Spread out over this marketing year, next marketing year. I think they reported that was maybe the fifth highest on record for an individual sale. So that was some positive news. On the supply side, about 1 billion bushels of corn is still unharvested in the northern corn belt. I'll take a look at that in just a second. Basis strength is encouraging some moderate selling. So we've seen quite a bit of basis strength, particularly in the western half of the state. And that's needed to attract corn into the pipeline. Farmers have been pretty aggressive at storing a lot of corn post harvest, and so basis has been strong, particularly in the west, as encouraging sales into the pipeline. South American crop prospects; those are coming more into focus and will be market movers here over the next several months. Right now, things are generally favorable, although South America has been leaning a little bit drier. So that'll be something, southern half of Argentina, I should say, has been leaning a little drier. So that'll be something to keep our eye on there. This first slide here is just a satellite image of eastern part of North Dakota. I came across this sent to me today. Kind of an interesting slide picture on eastern South Dakota. So you got the white background, which is the snowfall. So we've got several inches of snow in this part of the country. That's interfered with harvest. And those little black squares, though, is what they think is images of corn still in the field in this area. So you've got the white background of the snow with the black contrasted by these black, which are just fields of corn that are still yet to be harvested. So clearly a lot of harvest left to do in this part of the country. USDA reported earlier this week that we had, I think North Dakota was 43% done with harvest. Minnesota was 74%. Wisconsin was also 74%. Minnesota 93% done. Ohio 93%. South Dakota 83% done, and even a few percent left in Illinois, Indiana, and Iowa. Missouri is at 98% done, so mostly done, but almost all these states typically are completed harvest by now. So that's why we kind of make this ballpark estimate of something like 1 billion bushels still unharvested. So when we look at the at supply and demand here, so under that 2019-20 column, you've got the yield there at 167. So with all this corn left still in the field, I think trade is leaning a little lower on the yield. Probably, I would guess, half to at least a bushel, something like that, down on the yield. So I think expectations next month will be for something like 50 to 100 million bushel decline in the production estimate there at 3.661 billion. So may take it down below 3.6 billion. We'll have to wait and see. Not a foregone conclusion by any means, but that's I think what the trade thinking is at present. And if you go on down to the demand categories there, you can see a pretty big reduction projected for this year on feed and residual. You've also got ethanol about flat. On down there, you've got exports down from 2.065 last year to 1850 this year. You see, and compare that to 2 years ago when we had exports over 2.4 billion, and this year down to 1.85, and I think somewhat vulnerable to even further reductions going forward. So we'll have to wait and see. USDA held the line, didn't change the export forecast this month, but sales are lagging quite a bit. So the sale to Mexico is quite a positive news, and we'll need to see some more of that kind of thing if we're going to hold this export number at 185 or anything even a little higher. Total use is at 13.9 billion. Notice that that's down 900 million essentially from a couple of years ago. So if projections are realized the way they have it there, this would be 2 years in a row with usage falling, which is kind of an outlier, really. Typically, we might see 1 year where usage declines, and that's probably because we've had a short crop and prices moving higher, rationing demand. So you have that, year where usage is down just because you've had a short crop and higher prices. And it's certainly not a high price issue this last couple of years with usage. A little bit interesting to see this down. We haven't had something like this in a number of years, where we've had 2 years back to back with usage falling. Kind of is I guess a sign of concern and why the market has been fairly lackluster here of late, particularly. Ending stocks projected at 1.9 billion, down from a little over 2.1 billion last year. So still a large stocks here domestically. Go over to the next column there by 2021 with the FAPRI's estimate on acreage, looking for plantings to go up 2.5 million acres or so next year, with a return to trendline type yields at 176.4. With that kind of increase in yield and in acreage, wind up pushing the production up to over 14.9 billion. We see a little bit of recovery in use, but nonetheless, stocks build to 2.2, 2.3 billion next year. So still a fairly large carryover for corn. And I've seen private estimates for that carryover, up even as high as 2.7, 2.8 billion bushels. So some folks looking for a little larger increase in acres and even a little higher yield estimate. But with FAPRI's numbers there at 2.255 billion carryover, they've got the price falling, from 385 this year, season average in 2021 of 353. Turning to some of our export competitors, Argentina and Brazil, we've got first of all Argentina there on the left-hand side with the area essentially flat from last year. A little bit of a reduction in the yield. Still production pretty large at close to 2 billion bushels, and domestic use edging up just a little bit from last year, up 48 million bushels, so a small increase. Exports are down a little bit, 1.3 billion compared to 1.4 billion last year. But keep in mind, these are still really large numbers for exports out of Argentina. Stocks, fairly small at 200. A little 200 million. I mean, it's an increase year over year, but Argentina doesn't tend to carry a lot of stocks, like we do here in the U.S. They pretty much, price everything, get it exported, and so they don't tend to carry large inventories, to subsequent marketing years. Over in Brazil, harvest area up 3.4%, 44.7 million acres. Yield right close to 90 bushels per acre. And we see production basically steady with last year at 3.976 billion bushels. Usage or total supply down a little bit. And then the usage about steady with previous year. And we wind up with exports at 1.4 billion bushels, down a couple hundred million from the previous year, but still similar to Argentina, still a large corn export number for Brazil. I know the situation in South America, as I mentioned, Brazil's doing reasonably well. A lot to be yet to be determined, I should say, for Brazil, because essentially three-fourths of their crop hasn't been planted yet. It's the second crop, the corn crop that follows, the soybeans, Mato Grosso, for example, and the beans haven't been harvested and the corn planted yet. So a lot to still out ahead of us there for the crop in Brazil. Argentina's a little over half done, should be about half done planting. Their planting season is spread out over a few months, actually. So they'll be wrapping that up, planting up here over the next 4, 5, 6 weeks. And weather down there is reasonably good in Brazil, although, as I mentioned, southern half of Argentina is turning a little drier, so I have to keep an eye on that. Ukraine, another competing country on the export front for the U.S., see there that they've got harvested area up 7%, looking for kind of a return to more trendline type yields after big yields last year. And then following down to the bottom of the balance sheet there, you've got exports up at close to 1.2 billion bushels, pretty close to where they were last year. And again, a very strong number for exports out of Ukraine. This kind of wraps things up into one slide in terms of our export competitors, their production, and what we're looking at for exports out of those countries. So the bars are the Brazil, Argentina, Ukraine production. You can see how their production has grown pretty dramatically, over the last 10 years or so. Gone from 80 million metric tons up to 180 million metric tons, with those three countries combined. The red line are the combined exports out of those countries. So we're looking at combined exports out of those three at about 100 million metric tons, or that equates to about 4 billion bushels of corn. So those three countries, exports projections at 4 billion. That compares to the numbers out of the U.S. at 1.85 billion. So more than 2 times level of exports here from the U.S. So clearly a lot of competition from these origins. The U.S. share of trade, so we've seen that growth in production and exports out of those three countries. It's really taken a toll on the U.S. share of export trade. So we've gone from, back in the 90s, where we were pretty dominant market share, somewhere 60-70% of global trade, down to about around 30% in the last year or two. So we had a big recovery from 2012. That big spike down, that was a result of the drought here in 2012, which we had. So we had the tight supply and high prices, restricted amount of corn we could export. Recovered somewhat from that, but still, kind of in a downtrend, I guess I would say, for global trade of corn. This is looking at current situation with corn exports. So this is our the weekly corn export sales and commitments, sort of the cumulative numbers there. So that black line, the black dotted line, is the current year. So we're down at about cumulative number, I think about 574 or 5 million bushels. That's about half the level that we were a year ago. So down, about 480 million bushels from last year, and that compares to USDA's forecast for corn exports to be down about 215 million. So that's why the trade was expecting a possible reduction in the WASDE export forecast this month for corn. It didn't happen, but the slow pace of exports thus far is why trade was thinking that we could see that downward adjustment. The next slide kind of breaks this down by country. So the blue bars there is Mexico. Mexico's become our largest export destination. Prior to that, Japan was. Mexico's taken that role over, and you can see that blue bars there on the 1920 column. That doesn't include the big export sale that was announced today. So that will help make up some of that loss that we see there on the bars for this year. So the pace will, once that's added into these columns, it'll show some improvement there. However, the sales to Japan and also the green there, which is South Korea, we're way off in sales to those countries, or to that country, plus down in a lot of these other smaller destinations as well. If we look at exports on a marketing year basis, you can see, a few years ago there, we were all the way up to a little below 2.5 billion. So a strong export year is something, close to 2.4 or over 2.4 billion. We're looking at something closer to 1.85 this year, maybe wind up even a little bit lower than that. So even though we've seen growth in global demand, our exports here are kind of flat, kind of range bound between, let's say, 1.5 billion bushels up to about 2.4 or so. This next slide is just looking at the carry in the futures market for corn. So the gold line at the top is what the market structure of the carry looked like in the futures a month ago when we had this meeting. You can see, a fair amount of carry in the market, which is pretty typical when you've got supplies like we have this year with something closer to 2 billion carryover. The market's job is to put that carry in the market to create an incentive for farmers and owners of corn to store, pay them incentive to store the crop. Now, since then, the black line was as of yesterday. It doesn't include the update that we got in the market here on Thursday. So the line is down just because prices were lower from a month ago. The carry in the market is roughly the same as it was at this point last year or last month. I would say that if you kind of look at this in perspective of percent of full carry, we're about 25-30% of full carry. So, the carry that's in the futures is not, not all that rich. It's something, would be something closer to 60, 70, maybe 80% of full carry. That's kind of the outer band of what you would expect to see. So we're probably average or a little below in terms of the carry in the futures market. Turning to basis for a minute. So these two graphs, the top one is Kansas City. You can see the basis has recovered from harvest, and also note that it's carrying about a 20-25 cent premium to the 3-year average for a basis. So the basis has been strong, and that's just kind of use this Kansas City location as proxy for, let's say, about the eastern half of Missouri. Same sort of, you apply the basis in several locations in the western half of Missouri, you'd see something pretty similar. There's 20-25% gain over the 3-year average. The other thing I point out here is it looks like we may have seen a lot of the initial post-harvest gains on the basis. Last week or so, it started to tip down a little bit, and that's pretty much in line with what you would expect to see seasonally. The question will be whether we can maintain this premium to the 3-year average. I guess one point I would make that farmers have put a lot of corn in storage. We get the stocks report next month. We'll see how much we can compare to on-farm stocks to off-farm stocks and versus last year, and kind of get a sense of that. But my sense of it is that we've stored a lot of corn, which has been positive for the basis. But at some point out here, where farmers are going to turn loose of some of those inventories, especially I think once we move into the new calendar and tax year. So I think that there's some vulnerability there for basis as we move into 2020. On the graph below, this is New Madrid, or down in the boot heel. This market is driven more by the river, and with the export market, fairly lackluster in terms of exports. Not sort of the need to bid more aggressively on the basis there. Thus, it's a lot closer to the 3-year average. And again, it's also seeing some near-term weakness there in the basis. So some of this, I guess, the bulk of it, I think what I would think that call the post-harvest recovery is probably in place now, and so I would look for basis to be more, steady to maybe a little lower into early part of next year. Here's the futures market, the March corn futures. You can see we've been in that extended downtrend, that line across those highs. I think you clear that downtrend, especially if we can push the March futures over, 380 and certainly over about 385, which is that last little high there earlier this month. That would be a positive sign, saying at least maybe we're shifting the downtrend to more of a sideways pattern. We came within just 5 or 6 cents of those September lows here this week. So far the market has managing to hold that, and with the gains today, a positive sign that puts us at least some chance that maybe we can kind of break through some of that downtrend resistance. I put the soybean corn price ratio slide in here. This is just looking at the November soybean 2020 contract versus the December 2020 corn futures. Plotting this as the ratio of prices, soybeans divided by corn. You can see from back there in the late spring, early summer, the ratio got down to something close to 2.2 to 1. Since then, it's recovered back to roughly 2.4 to 1. That low was back associated with the big price rally on the planting delays with corn, and since then corn prices have eased, and so this ratio has moved back to this closer to 2.4, which is really a lot closer to the long-term average. If you look back years, kind of looked at the range on this, something close to 2.3, 2.4 would be close to a kind of a neutral or average for that. If you push this thing, the ratio up closer to 2.8, 2.9, then it's clearly incentivizing soybeans over corn. I don't think this year the corn market really needs to incentivize a lot of additional acres, as we noted on the supply-demand projections for next year. It looks like we're set with an increase in acres almost by default because of a return to normal planting weather and a return to trendline type yields. We're going to see stocks likely increase by some amount. So this is the December 2020 futures. We saw a little bit of a rebound here today. Similar, if we could clear that little downtrend line, push the December 2020 futures back to say over about 395, that would be a positive sign there, and probably put us on track for something back to this 4 to 405 area for the new crop, which I think would probably be a spot where you should want to consider some at least some light new crop sales. So kind of wrap this up. Post-harvest basis gains are probably in place. So if you have a chance to lock in some basis, these levels, probably take a hard look at that. Corn prices should respond to South American weather threats. So if we do see some issues with Argentina, and then perhaps later on with the safrinha crop in Brazil, global stocks are not so burdensome that I think the market wouldn't respond. I think it would respond if we did see some weather threat. Even so, if we get a little bit of recovery here, I would, in the new crop, I would be considering some 2020 sales, here even in the early part of 2020. And as I mentioned already, with normal yields in 2020, looks like we're going to build stocks next year. And if we build stocks back to 2.2 or 2.5 billion bushels or something like that, we're probably looking at that December futures contract, moving, below 350, probably closer to 3.25 or something like that, by next September, October. So with that, I'm going to turn it back over to John to talk about soybeans.
Okay, on the soybean side, I'm going to start off with the just the supply and use for soybeans. Not really much of any change from the November report, so nothing exciting for us on area supply or demand. But on the farm price, USDA did revise it down 15 cents, so we're now at $8.85 instead of $9 a bushel. Part of the concern is, as we look at what's happening with African swine fever in China and how that's impacting the swine herd there. We've talked about in previous sessions the sow inventory down 30%. And so some of those things translating into the potential for weaker demand in the long run, in addition to fairly large supply coming out of South America. And so if we look at our export projections there for 2019, you see that 1.77 billion bushels compared to 1.874 next year, a little more optimistic outlook, gain of about 100 million bushels. But still, you see with return to normal planting, a significant growth in production, and you see also at the bottom there, from a ending stock perspective, we're actually up to almost 500 million bushels, and we're at an $8.54 bushel price outlook. So as you look at soybeans, keep in mind that there's a lot of things going on in the market right now. We may get a bump from China. Don't miss those pricing opportunities because the outlook is not great. As we look at accumulated soybean exports and outstanding sales, we are slightly above last year's pace at this time. And it's really kind of interesting because as you look at this, one of the things that has happened is we are a little bit ahead in terms of what are selling to China versus last year. And yet we find ourselves very close to the same level overall. And so as we go to China, you can see here we've got almost 400 million bushels sold compared to last year at this time, which was almost nothing. And in fact, they were canceling sales at this time last year. So, um, we are ahead of the game. But the thing to worry or that I'm a little concerned about is typically sales and exports to China will taper off as we get a little bit uh, past the 1st of March. And so by the 15th, they've almost completely shifted over to South American purchases. And so our window of opportunity for sales to China is going to be quickly closing, combined with the impact of possible lower demand from African swine fever. So two things to kind of keep an eye on. So what we want to watch for as we see new prices in March and February and January. So as we see an opportunity to price some soybeans in that range, we ought to take advantage of it, because once we get past March, we may lose our opportunity if that South American crop is as big as we think it could be. Um, at this point in time, looking at just year-to-date accumulated U.S. soybean exports and outstanding sales. Now, keep in mind, this is from the 1st of September through to November 28th. And so you can see this year we're up significantly relative to last year, but according to 2 years ago, if we look at it back that far, we're not even half of what we would have been at this time 2 years ago. So this is where my concern it comes into play. Maybe we'll get some late season sales on soybeans like we did last year, but I wouldn't count on that. And we may end up actually in a very similar spot on total soybean exports to China this year as where we were last year. You'll notice also on there, European unions had a little better year with their protein production, and so their demand is down just a little bit from 2018. And if you look out there, Mexico about the same, most of the rest of them about the same. Easy for them to bounce around a little bit and recover and be about the same as where they were. If we look at soybean supplies in competing countries, again, not a lot of change from last month, and I've been saying that for 3 months. I think the comment that I would point out here is notice that both Argentina and Brazil have responded in a significant way on their area planted this year. And so, this will be the crop that gets harvested in 2020, but look at the size of those crops. They continue to be large, and in fact, very large for Brazil in terms of its expected production. And that's going to give them a lot to export. And so we're not going to see much of the pressure come off in terms of competition with U.S. exports. And so I think that's the concern I have for prices as we look a little bit longer term. This is the January soybean futures and so when I look at this and I see, okay, well, we've had a little bit of a pickup, and we probably are going to have a little bit of a pickup as we get into some of these trade discussions, and hopefully there's going to be some resolution, and maybe we'll make some quick sales in a short period of time that'll bump that market up, and the traders will get excited, and maybe we can get up in over that 950 price again and up maybe even closer to $10. But when that happens, we need to take advantage of forward pricing some 2020 crop and pricing some 2019 crop if we haven't already done that. And then what will happen likely is that bump up in prices will not persist. They will overreact, and we'll see it trickle back down. And what I'm worried about is if we have a season average price projected next year by FAPRI of 853. If we see that kind of a season price, that's going to mean at harvest time, we're probably looking at 20 to 30 cents below that. So an 820, maybe even a price that starts with a 7. And that's where I'm worried. We need to take advantage of pricing opportunities this spring when we come across them. Overall, on the soybean outlook, there's really not much change from the November estimates. We're a little weaker on prices. Up until a few days ago, their trade agreement was kind of bouncing around, wasn't really a lot of excitement, but maybe we will get some excitement now. And so that's something that we want to keep an eye on. We do know, though, that there's a lot of soybeans coming in South America unless we get some sort of weather event. But let's go to let's look at the pricing opportunities and take advantage of those that occur in this early part of 2020. That's what we want to watch for. That's what we want to get a hold of. So with that, I'm going to translate it or send it back to Marty, and he can take you through the wheat outlook.
Hey, thanks, John. So I wanted to start with the global situation and kind of go over a few things there, and then talk a little bit more about the domestic situation. So just to kind of give you an overview of what's going on globally, you can see this is a graph of the production and consumption, over the last 20 years or so. You can see that green line there at the top. That's where that's production, and you can see there on the right-hand side where production is forecast to climb this year all the way up to a record high of 765 million metric tons. So that would be up almost 5% year over year for wheat production. I guess also the thing of note here is that, yes, domestic consumption or global consumption of wheat has been climbing, but you can see here for the last several years, production has been exceeding consumption, and that indicates that stocks are building around the world. So you see that space there between those lines, production well over consumption. We're building wheat stocks around the world in a pretty significant way. This is a graph looking at stocks to use. And you can see how we've gone from something like a little over 20% stocks to use back in 06 or 06, 07, 07, 08, up to about 36% this year stocks to use. So historically, we've recovered back to a pretty high level globally. Now, China is included in this, so it makes it seem a little worse than it might be, but nonetheless, it's still a large global supply of wheat. Looking at some of the, or I guess you're looking at the domestic balance sheet. So on corn, they were expecting a little bit of a cut in exports, and we wound up with no change. One of the crops they did change, though, was wheat. So we had a couple of things happen. They initially lowered the imports on wheat down to 105. I think it was a 15 million bushel cut from November. I think that stems from the idea that Canada's got some quality issues with their crop because of the delayed harvest and rain and snow conditions. So a little less quality wheat to import to the U.S. I think that's part of it. The other thing on the demand side is the USDA boosted the exports by 25 million bushels from last month up to 975, which is a little bit of a positive that the trade wasn't expecting. Not a sort of a game-changing sort of thing, but still headed in the right direction. A little bit of a positive number, and you can see there that resulted in a 40 million bushel revision down in the ending stocks down to 974. So we're down a little over 100 million bushels from a year ago on the ending stocks now for wheat. Still a large number though for stocks. Still not in danger of running out of wheat by any stretch. But a little bit of tightness there. USDA did revise the season average price down 5 cents a bushel though to 455. I guess just based on probably on the on the prices that we've seen so far in the marketing year. I mean, we're moving so that we're getting close to halfway through the marketing year on wheat. Well, before I leave that, I want to point out on the right-hand column there with the FAPRI numbers, you can see planted area. So in addition to a lot of these estimates we're coming up with, next month on January 10th with the WASDE and final crop production. They'll do a final crop production for wheat as well. We'll also get winter wheat seedings report from USDA. So that'll give us an idea of, where we're at with winter wheat seedings. The FAPRI number is essentially steady on overall wheat plantings next year. But we'll get an idea of where the winter wheat seedings is or starting out at least. I think one of the concerns I guess I have is just that with some of the late row crop harvest, if we were able to get as much of the winter wheat seeded as we maybe would have liked. Nonetheless, with acreage about flat and the yields down a little bit, we wind up with production down. But even so, usage is projected to decline. So we've got usage down, total use down at 2 billion bushels, or down 131 million from what's projected for the current marketing year. So, and a lot of that is driven by lower exports next year. So we wind up with ending stocks about the same as this year at 979 million. So we don't make a lot of progress in terms of whittling down these large stocks, even with a smaller crop, because we're looking at lower use next year. In competing countries, European Union and Canada, I would call these traditional export competitors on wheat. You can see the EU crop, their production is up at 5.6 billion bushels, up 12% from last year. So a big recovery there in their crop. The other is Canada. Their production is up only 0.5%, but still a pretty large crop in Canada. We're also looking at exports about flat in Canada. We're looking at a pretty big recovery in exports in the EU, up to 1.066 billion, up a couple hundred million bushels from the prior year for the EU. So a fair amount of export competition from those traditional exporting countries. The other thing I'd point out, though, is we're facing a lot more competition from other origins, particularly Russia. So this graph's got quite a bit going on here, but let me kind of explain it. The gold line there is trade year exports. So this is the amount of wheat that's being traded around the world every year, and you can see that number has gone from about 100 million metric tons up to 180 million metric tons over the last 20 years or so. So there is growth in global trade. However, that dashed black line is our share, U.S. share of global trade. You can see that's been trending lower, and kind of inverse correlation to the red dotted line, which is Russia's share of export trade. So over the course of this period of time, we've seen U.S. share of trade decline and Russia's share of trade increase. So in pretty much direct proportions, right? So anyway, we're facing a lot of export competition. Similar to that graph I showed on corn, our share of trade in wheat has gone from 25-30% of global trade down to something closer to 15% here the last few years. If you look at exports on a marketing year basis, you can see we're looking at exports at 975 million bushels this year. That's kind of an average year. If you averaged all those years in the last 20 or so, that's probably close to an average. Not a real poor year, but not a real great year when you're exporting something like over 1.2 billion. Similarly on the stock side here domestically, we've got those bars there, stocks to use, up over, got over 50% stocks to use. Now we're pulling back something closer to 44-45% stocks to use, but still historically a pretty large supply of wheat here in the U.S. And prices clearly inversely related to the stocks So we've got, with stocks building, prices have been under pressure. And the projection for this year is something a little closer to 450, 455. Also point out here the acreage. So this is a long-term trend in wheat acres here in the U.S. have been, falling pretty consistently. 20 years or back in the 1980s, we were planting 80, 90 million acres of wheat. Now we're falling down here to about half that, something closer to 45 million acres. So a long-term decline in wheat acres. I know we, over the years have been looking for that bottom, and where are we going to where's the end of this downtrend in the wheat acres, and so far yet to see the bottom of that downtrend. So we've kind of stabilized, I guess, somewhere above around 45 million. So maybe we're there, but we need to see a little larger uptick, I think, to kind of prove that point. Price-wise, here's the July 2020 futures. You can see we've had a pretty decent little recovery in wheat prices and the futures since September. This is kind of a normal seasonal pattern. Look at the more nearby contracts, you'd see something similar. This is the Chicago wheat futures. So a pretty decent seasonal recovery in wheat, and that's pretty typical from, say, September to Thanksgiving, Christmas timeframe. So I think we've probably put in a lot of our seasonal recovery, at least initially, here in the wheat market. One thing I would say too is we've got a little bit of strange price relationship with wheat, between the classes. Unusual situation with the fact that we've got the Kansas City wheat trading at pretty steep discounts to the Chicago market. Usually it's the other way around. Your hard winter wheat's trading at a premium to Chicago, and the hard red spring at a premium to those other two classes. Not the case this year. We've got big discounts in the Kansas City versus Chicago, and we've even got hard wheat in Kansas, for example, early this late summer and fall trading, even with the corn market. So wheat in the plains has been trying to price itself into feed rations there. I guess we'll see how successfully that materialized based on what the stocks report says. Next month when we get the December 1 stocks report, that'll give us an idea if we did do much wheat feeding over the course of the fall quarter. Typically, most of your wheat feeding is in the summer quarter, not the fall quarter. This year may be a bit of an exception based on those price relationships. Anyway, I think typically, you get this kind of a price recovery. It's probably a good time to sell a little bit of old crop wheat and maybe even start on some of the new crop. But typically, post so say Thanksgiving to Christmas time, and then early in the following calendar year, usually it provides an opportunity at least to get started on wheat sales based on the seasonals. So with that, I'm going to turn it back over to John.
All right. Thanks, Marty. We're going to look at the livestock outlook now. And just some a quick note here. We know that we've been having some amazing production gains in the meat sector. And if we look at the sum of beef, pork, and chicken, if you would have asked me in 2014, could we sustain this type of growth? I'd have probably said, well, not without much lower prices, but yet we have not found ourselves in a really, really low price situation. And so that just speaks to the strength of demand. And so it really has been pretty amazing. And you can see it continuing to grow into 2020. And so when we look at this, the concern is how much meat is too much for U.S. consumers. And look at where we were in 2007 prior to the recession. Compared to now, we're up already 4 or 5 pounds over that level, and that's pretty amazing. That we can absorb that much meat per capita. So it does speak to the strength of demand. There might be signs that we might be slowing down a little bit, but it certainly looks very strong right now. As we look at the production and trade situation, We have revisions from last month. You can see here production's gotten even higher, which isn't ideal. It's about uh, 0.3 billion pounds higher in 2019 and 0.6 billion pounds in 2020. And then if you look at where that's coming from, in the case of 2019, it's beef, pork, and chicken, each up by about the same amount. But in 2020, most of that gain in production is coming from chicken. And so when we look at then at the export side, here's where I'm starting to get a little concerned. The exports are actually weaker this month. And so we have pork down 0.2 billion pounds, both in 2019 and 2020. Maybe a little more strength in chicken in 2020. So, and then we have kind of the whole additional imports of 0.1 billion pounds. So with that, when we start to look out at per capita consumption, here we are in terms of pounds per capita, 1.4 pounds per capita higher in December than November's estimate. And then for 2020, it's 1.7 pounds per capita higher. So you see, we've got some pretty optimistic meat consumption. And one of the things to keep in mind here is, of course, meat consumption is very tightly tied to economic performance, and certainly the economy is looking good. It's there's not very many signs out there that we would be near a recession, and certainly with an election year next year in 2020, we would not expect a recession to be in that year. Um, so it is one thing to kind of keep in mind. So as long as our economy is hanging in there, and perhaps these gains in per capita consumption are possible, but it does indicate, it is a warning signal for us that we should watch in the next 2 or 3 years what might happen. Right now, prices, at least from last month, for fed steers are up about $1 per hundredweight, both in 2019 and 2020. Pork price is a little less optimistic for 2020, down a couple dollars per hundredweight, and then chicken prices up $2 per hundredweight for 2020. So, again, reflecting stronger demand for poultry. Now, turning to the beef sector, one of the things that has been a positive sign for prices has been a little bit higher beef cow slaughter. So this is kind of a signal. We look at that and we look at the number of heifers placed on feed. We can start to get a sense that the beef cow herd is contracting, and that is good news for prices in the sense of lower production longer term. And so when you look at this in the actual beef cow inventories, you can see that we are now turning down, or at least projected to be turning down, as we get into 2020. And so that will be one of the positive aspects as we look forward for fed cattle prices. This is slaughter steer prices, and with the exception of that little blip down right there before October, which was due to the fire at the Kansas slaughter facility, we have pretty much been on track with where we were last year. And so one of the things to keep in mind is that, in fact, we may actually be in the year a slight tick above where we were in 2018. And so modestly optimistic about slaughter steer prices. When you combine that with weaker feed prices possibly into 2020, it would seem like this might be an opportunity. And you can see here, one of the things that I think has sent the signal to beef producers is the weakness in steer calf prices. And you can see we've been consistently weaker really since about May. And so that may be part of what the signal is. And so As we look forward, you can see them kind of coming back to 2018 levels. But some of that culling has already been done, so we may find ourselves in a reasonably profitable situation for the Fed market. So if we look then at barrel and gilt prices, now this has been a really volatile market. It's been one that's largely been shaped by the China discussion and what's happening, particularly with exports to China. I will say that, for the most part, to date, the expectations that we started with aren't necessarily, haven't panned out to be maybe where we might go or might have thought we were going. We've probably overestimated how much they were going to import, and so as we look at weekly pork shipments to China, yes, they've had some bumps up. We take a look at this now. This is going to be 1,000 metric tons that are exported each week. So it's yes, we've gotten perhaps up 50%, but keep in mind that is so even if we were at 10,000 metric tons and we multiplied that by 52, that would be 520,000 metric tons, and we're not going to get close to that. And so here, if we look at the rest of the market, yes, there could be an opportunity here for us to jump up and possibly see a bump from China. But notice that China makes up a relatively small portion of the total in pork exports, and so yes, they may jump out there. We probably are a little bit. We've been a little optimistic in the past. Maybe we will, as we look forward, we will get to the point where we can actually get a better estimate of what China's actually going to do as a result of African swine fever, and if they really truly are going to import more pork. So this particular chart shows you the WASDE price projections for fed steers and barrels and gilts across the last year and a half or so. And so one of the things that's interesting as you look at 2019 is we first got really optimistic about January and March, and then we kind of got a little bit more pessimistic as we look towards September, and then now we're back up again, closer to $117 per hundredweight. So, kind of been all over the place on price projections this year. On the other hand, barrels and gilt prices, we were pretty optimistic in May. That was fueled by speculation about China. But now we're back down from the peak of $54 down into that $48 range in terms of our projections for 2019. And these are, I should say, USDA projections. And then finally, turning to milk, if you look out further in terms of where WASDE production price projections have been, gradually creeping up for milk. And so some of it has been, we've had a really large reduction in the number of dairy farms and just, a lot of economic pressure there. Hopefully this will begin to relieve some of that economic pressure, as supplies ease back, and hopefully there's some opportunity for demand growth. So with that, I'm going to stop the livestock outlook. I wanted to mention to you, though, future outlook presentations are planned into 2020, and the schedule is listed here. We've got, we're normally going to be doing them about 1 o'clock in the afternoon, with the exception of February, which is set for 3 p.m. The other good news is that the phone numbers and web links are all going to stay the same. So that will help us a lot. And in terms of, you have the same numbers to call in all the time. And by all means, if you have any questions or any topics that you would like to have addressed in the future, let me know. My name is John Cruz, and my email is krusej@missouri.edu. You can also find a recording of this particular Outlook presentation on the MU Extension website, or you can also see it on our YouTube channel, or also on the AMAP website. So with that, we'll close out the December Outlook, and please let us know. We'd love to hear from you if you have any questions. Thank you.